The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 115 of Wealth Talk. My name's Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by our founder, Mr. Kevin Whelan. Hello, Kevin.
Hello, Chris. Good to be with you again.
Yes, here we are. And we're kind of touching on a topic today that was first covered back in February 2019. Can you believe it? Episode 4, where we talked about how to uncover hidden money in your life using debits, which is one of our famous acronyms that we have inside the Academy program. But we're focusing on just the D today, which stands for debt.
Well, I love a good acronym, as you know, Chris, and spend my life trying to manufacture good acronyms for easy teaching. Debits is a great one, and we'll get to that. But the thing, I think it's really important to sometimes revisit things. I think for two reasons. Those who've followed the process will have changed by now. I mean, if you were listening in February 19 and you're still listening, thank you. We're still committed to delivering great content and value for free for anybody because we want 50,000 people to become completely financially independent. And often people don't start because they're a bit overburdened. They think they don't have enough money when in fact there are things they can do now. And the obvious one, and it sort of came to me, Chris, when I was talking to one of our members the other day, and it's interesting. She said to me, she's making great progress. She's got to financial security now. And she said, I need to tell you something. And she went all quiet on me, and I looked on Zoom, this was. And she said, I'm going to get a job. And she said, you're not going to like it, are you? And I said, okay, what's the logic? She said, because I've got some debt in my life, right? So we know debt is good debt, bad debt, double-edged sword, and we'll talk about that. And I need to be at a point where I can refinance my home. And the best way to do that, and the only way I'm going to be able to do that, is if I have the security of a job. And I thought about that for a moment, and we laughed, and she and I said, look, if getting a job, you see it as temporarily playing on a team, delivering value, getting back into the workplace, knowing it's temporary, enjoying playing for another team, and allows you to refocus your debt and get a lower interest rate. So for the long term, because you've got an employment now, how bizarre is that somebody thinks you're more secure in a job when the very fabric of work is so much harder now, and people losing jobs and furlough and all those sorts of things, when building wealth is the most secure thing you can do. So we laughed about that. I said, just play the game. You know, if it works for you and you get a big difference in your debt, and you can dramatically cut your costs, and you do so temporarily in the full knowledge of what you're doing, I think it's not a bad thing. So she was doing kind of quite a smart thing. But most people don't do smart things with debt. They do dumb things with debt. And it's not taught in school, and it's nobody's fault. The whole kind of system of the UK and US and other countries is kind of wired for people being in debt, really from the very early age. And as we reflect, Chris, in the coming weeks, we're working on the Wealth Builders for Teens. One of the key things we need to get across is having kids not see debt as an automatic thing in their life. You know, the fact that you pick up a bit of plastic, like a library card, you know, they can think that plastic pays things, but in reality, plastic, by removing the connection to real money, you know, you could hear the ka-ching or the cling or the clang of money and the touch on notes. That's all been removed, and the pandemic has done that too, isn't it? Everything is touch, isn't it? Everything is, you know, you just tap. And I think the removal of the connection to money is going to make it harder for teens because everything they'll do will be online. And I think this is going to make the matter worse. So I think it's great that we revisit this subject. It's good that we're going to be putting some of that into the kids one, the Wealth Builders for Teens, which is coming up. So, if you're interested in being a great steward for your own kids, get in touch with us and register your interest in that. Join the Facebook group. Just get in touch and let us know you're interested in helping your kids. But the other thing, of course, is to remind people that if you have any debt in your life, money's flowing out. And the principle of wealth is money flowing in. So you've got to be very careful when you think about how debt works in your life and be ruthless in the attention to it, which is why it's front and center in our debits process, because it's not just the money flowing out, but if you think about it, whatever you buy on debt, whatever, it's going to cost you more because you've got to add that interest cost to it. Now, we know there's good debt and there's leverage debt, and I said we'll touch on that. But when people are using in proliferation, cards to pay for things that are wasting assets, they're not assets at all. Actually, their cars, their TVs, their things of life consumption, and just forget that the cost is being loaded up. And just because you can afford to make the monthly payments doesn't make it a good thing. And I think that's the important basic context for this. And I cover this actually, Chris, in a book I wrote some while ago now, actually. You talked about this episode being a couple of years old. I think I wrote this book 2004, if I recall it. I paid my own mortgage off in 7 years flat and wanted to teach other people how to do the same. So I kind of coined the term debt-free day, the day when you own everything and owe nothing. And that's a simple mantra, but it's really aimed at people who perhaps want to focus on the elimination of debt and then build their wealth. I think it's best to do them side by side, because if you can reduce your debt and therefore increase your monthly inflow because you've eliminated something, then I think you should plant the seeds of the money you save and build wealth with it, as opposed to just waiting till you paid off all your debts and then start, because all of that money that you saved on the journey has been lost and is dissipated, and like seeds just drifting on concrete, they're not going to germinate at all. You get the point? So that was a long and rambling context, but it really shows how important this subject is. And thanks, Chris, for suggesting we should revisit it.
Yeah, no, I think that sets the scene very well. And we've been talking, obviously, on previous episodes about our 9-step recurring roadmap. And this sits firmly in step 2, which is foundation. So debits is part of that step 2 process and reviewing your outgoings. So, yeah, referring to the book then, Kevin. So Save a Fortune Fast, 12 Secrets to Eliminate Your Mortgage, Loans and Credit Cards, as you say. First published 2004, and we've got a free PDF copy as well. So we're actually going to run through some of those secrets in today's episode. So we'll go through the first few. But if anyone would like to download a copy of that book for free, then you can just head to wealthbuilders.co.uk/save a fortune. So shall we dive into secret number 1, Kevin?
Yeah, secret number 1. So it's, always pay the lowest interest rate you can. And that just means, like anything else in life, there's so much information out there. There's so much data. Then you can shop around to get the lowest interest rate on whatever debt you have. So the first thing to do is take stock, right? So, if you're not sure what you've got, you're not sure what you're doing because time has kind of moved on and you've just forgotten and you're just living your life, just get your, I know everything's online, so stop things online. Get your statements or, print the statements from your bank and get a highlighter pen and just highlight anything that's going out for purposes of debt, and then resolve to find the lowest interest rate. And just like you can switch other things in life, you switch to a lower cost whenever you can. And there's so much information out there. There's brilliant search engines now, aren't there, and supermarkets and all sorts of things, Chris, that people can use. And, when you move to a different debt, what you're going to be doing is, making sure that you've either pay that debt off quickly, or you just, there's other processes I'll talk about when people have got credit cards. So sometimes that can kill people when they're drowning in consumer debt. So, one of the ways to do that sometimes is to think about, merging, instead of having lots of different things. When you lose control, just consolidate to get your debts in one place, but do it once. Don't do it 50 times and keep doing it. It's a one-off exercise, and it's a very powerful thing to do.
Yeah, and make a note of the date that you've done it. So when that, 0% or that low rate perhaps finishes, you make sure that you don't want to forget about that as well.
Exactly right.
Yeah. Okay. So moving on to the next secret.
Secret number 2 is, pay the same monthly payment when you've reduced. So in other words, you were paying something before. So you've assessed what your total cost of your debt is. You've added it up. And then instead of going, woo, I've saved some money, either plant the seeds of that money in assets and start building wealth. Or if you want to keep accelerating your debt, just keep the payments the same. So if you're spending X, then keep spending X, but redirect the saving to some of your other debts so that you essentially maintain the payments. So you're not changing your overall income and outgoings. And if you have to, do a bit of both, but always, always, always do something with the money, that hard research. And it's valuable time, by the way, because when you analyze it and you spend a little bit of time, as we always do in debits, you spend a bit of time, but it's not just the money you save, it's the impact on the money you save that you move forward. And I would say anybody and everywhere should be doing this, because it's not just about those people with consumer debt. It's also the same principle if you've got leverage debt, so those people who will accept that actually, they're borrowing money at a low interest rate. So the different types of interest rate aren't there. So consumer debt is the high end, credit cards and overdrafts and those sorts of things. And also hidden fees. So, always be aware of what you're getting into. Don't just blindly fall into those things. But those who managed that, got out of that, and perhaps they've refinanced their home and they've got buy-to-let property, say, or other types of property that's mortgaged, it's still important every now and again to review those rates, because even if the interest rate you're paying is, say, 3% and the money you're making is, say, 8%, so you're making an arbitrage, you're gaining from the use of the bank's money for your benefit, but in the end, you're not in control of those interest rates. So, interest rates will go up at some point. So it's best when they're down to pay as much as you can and try and gradually reduce the percentage of your overall life that is in debt. So if you've got, often we'll talk about a thing called LTV, or loan to value. So if you've got a portfolio and, you're typically, when people are building their portfolio, Chris, they're building it fast. They'll maximize their leverage. They'll go sometimes 75, 80%. So they'll have a portfolio of £1 million, but they'll have £800,000 in debt. Well, if interest rates were to suddenly go up or gradually go up, they're going to eat into their profit. But also it means, if property prices were to fall and interest rates go up, they're getting in a worse position. So they're not really improving their position. So I encourage everybody, including our clients and members who build property portfolios, to have a plan to do this very same thing, review their interest rates and try and gradually move their overall reliance on debt gradually down from 80 to 70 to 60 to 50, and get to a place where you're bulletproof. So there isn't an interest rate that could change that would dramatically impact on your ability to be financially independent. So it's not just, I don't want people to switch off on this podcast, Chris, because they're already, I've sorted out my credit cards, I don't have those anymore, I've cut those up, I'm just using my card as a flexible tool, and I'm paying them the payments every month, which is all I do really, just have credit cards for the convenience of the payment and the convenience of the record keeping, but I never pay interest rate on anything. And that's important to get that psyche. All right. So that's the important part there.
Right. So we covered secret number 1, which is always pay the lowest interest rate on every penny you owe. Then secret number 2, maintain the same monthly payment after you've reduced the cost of your debts. So what's secret number 3, Kevin?
Well, don't you know any of the secrets, Chris? Or is it
Could it be don't underestimate the risks of being in debt?
It's good you're on the same page, aren't you? Yeah, when you're in debt, the money's flowing out. Okay, so when money's flowing out, it's going to flow out no matter where you are on your journey. Now, everybody's on a journey, and the roadmap that you talk about, Chris, and have so elegantly put together, is a roadmap that helps people move from financial insecurity through the milestone of security, from security to independence, and then onwards and upwards to abundance and so on. But on that journey, things go wrong, don't they? And they go wrong not just in terms of interest rate changes, as we're talking about now, or job changes and changes in business things, but things can happen also to our health. And in some cases, you can lose your health, and sometimes you can lose a family member or even lose your own life. And that's also part of the foundation, Chris, which is step number 3, which really talks about protecting your roof. So being watertight from the beginning of your wealth journey. And I just like people to imagine that if wealth is an up escalator, you stand there, you built your assets, you've done a great job, and you're standing on the up escalator, and it's pretty easy. You might manage your debt every now and again. You get it down to a manageable level. But once you build your wealth, if you've done it well, if you've done it in line with the principles we teach, you're standing on the up escalator, and it's really not hard anymore. But while you're in debt, and while you're not yet wealthy, you haven't yet established that, in truth, you're on the down escalator. That's fun when you're a kid. You remember in shopping centers and stuff, when the days when we could go into shopping centers, of course, you see kids, the escalators going down and they're running up, right? And that's what's happening in life. So the cost of life is forcing you, it's pushing you down, and you're working hard to get ahead and to go upwards. So it's really important that when you think about what could go wrong, if you're not quite wealthy yet, but you're seriously intending to do so, make sure that you've got some form of really solid insurance to mitigate the gap. So it says, if I were to get ill, I've got an insurance policy that pays my income until I get well again. If I were to die, I wanted my family to be financially independent. And those people who connect with me, Chris, will know my story and my father dying at 46. And consequently, at a very young age, he didn't have the chance to build wealth anymore, did he? He stopped. And consequently, he didn't have insurance. So there was no gap. There was no lump sum, essentially, to make a payment to keep the family safe. And consequently, the family were not safe. And I don't want that to happen to anybody. So if you committed to building wealth, and this is the key, then you will be wealthy for your family, even if you don't make it, because you can insure yourself. And some of the things you can do when you start to think about this really is if you're really focused on your debt, you're eliminating the cost of debt, some of the savings in that debt that I mentioned earlier on, if you're still not yet at financial security or independence, redirect the savings you make and put it into insurance so that you're covered no matter what happens. So treat the premiums that you pay as a cost of being in debt, so that as your debt reduces, you then start to cut the cost. I see so many people take out a life insurance policy. Well, they get sold it in reality, Chris, don't they? For like 25 years. That's not a plan. That's just life assurance. Well, if you've got a plan to be financially independent in 5 years, you only need insurance for 5 years. You don't need it for 25 years. So you see what I mean? So you can save costs everywhere. So we're not just saving costs on debt, we're protecting our family and we're reducing the long-term cost of insurance, because as your wealth builds, your need for insurance diminishes. And we get very smart, don't we, in Wealth Builders, where we actually encourage people to be business owners. And when they are legitimate business owners, as so many of our members are, Chris, then they become eligible for something called Relevant Life, which is where you can use the government to give you a tax relief, a tax break to pay for the insurance. So it's not just the savings on the debt, but the government giving you a tax break to do it. Come on, guys. This is really good stuff. So there's so many things you can do. So secret number 3 is make sure you've taken care of the risk to yourself and the risk to your family, because you want that debt to be paid off and you want to be financially independent no matter what. That's secret number 3.
Okay, and we actually covered off Relevant Life there for anyone that's interested in finding out more about that. That was episode 66 with SSAS Director Paul Brooks talking about 6 tax-saving tips for business owners. So I'll put the link to that in today's show notes.
Guide as well, Chris, is there not? Did he not write a little guide on it?
Yep, absolutely. So, we'll make sure we link to the guide as well. And so we're 3 secrets in, and we know there's 12 secrets in the Save a Fortune book, Kevin. So why don't we pause for a second and head over to Trustpilot and have a look for one of our latest reviews over the last 7 days. And a short and sweet one here from Friend of Ted, but a lovely one nonetheless. It says, Kevin and Chris have put together a phenomenal program full of content, community, network, support, knowledge, and deep dive specialisms across all the pillars of wealth. There we go. Thank you.
You know what? I like the simplicity of that one. So, we have sometimes, very effusive comments, don't we? And we have some very nice ones as well, short and succinct. So, and they're all very genuine, of course, from people who work with us. And we're thrilled and delighted that our reviews are so outstanding, because I think people are getting the message that we are committed to helping you, whether you pay to be a member or whether you don't. We want to help as many people as we can. As I said, 50,000 people. So if you've been putting it off, just join in and find out more. Join the Facebook group and you'll be able to tune in to some of the things we're doing. And when you're ready, come and work with us a bit more.
Okay, so we've probably got time for, I reckon, another couple of secrets. And secret number 4. So this is a process called Marshal the Forces, Kevin. So what's this all about?
Yeah, so you remember I spoke earlier on and I talked about the possibility, sometimes it makes sense on a one-off only, one-time only deal, consolidate your debt. Because mortgage debt, for example, is much cheaper than credit card debt. And it always will be. Massive differences, aren't there, really, in terms of the rates. But sometimes, you can't do that. It isn't possible to transfer into a mortgage or a consolidation. You just can't do it. So this is the way to do it. You basically, get it's all about data. So you've got to put yourself in a place where for an hour or so, maybe that's all it'll take, you just kind of line up your debts, put them on a spreadsheet or put them on a piece of paper if you don't fancy a spreadsheet, and line them up with in order of the interest rates, right? So the most expensive at the top. So find out the interest rate, 15%, 16%, 13%, then 12, and then 10, whatever it is. And then once you know what they are, the thing to do then is, without changing the overall payment, so whatever you're paying. But what I want you to do is make the minimum payments on any cards you have and take all the money that you were paying and paid off the highest cost debt, right? So you focus on the one that's charging you the most. You send as much money to that and the minimum to everything else. And when that's gone, celebrate. Cut up the bloody card. Move on to number 2. And then do that sequentially until you've moved and eliminated that consumer debt. So that's how you do it. And it's really simple. It's quite powerful because it allows you to see what's happening. It gives you a physical sense of success and moving. And if you do it once and you don't then go back into using cards again, at least if you're using them for the convenience, as I mentioned before, and that's what you do. So it's really quite a simple thing because most people don't do that, do they? They just pay whatever they can afford, if you see what I mean. Well, don't do it randomly. Focus like a laser on highest cost, then second highest, then third highest, and so on. So that's Marshall LaForce's secret number 4.
Yeah, and that is absolutely by far the fastest way to pay off those debts. Also, I've heard that referred to as like the snowball method. Just keep on rolling it and bigger and bigger and bigger. So
yeah, I've heard that one before.
Okay, that's a good one. So secret number 5 then, Kevin. So this is about checking your income and expenditure and looking for all the different opportunities to make improvements.
Yes, and it's twofold really. So on the one hand, there are ways that you can improve the net tax position on your income. We won't talk about that right now in detail because everybody's tax position is different. But there are always ways where you can increase your net income. And if you increase your net income, then by understanding tax concessions, tax breaks, things that you can do. I just mentioned Relevant Life, for example. Many ways that you can do something, and we'll cover that on another episode. But nonetheless, at the moment, focus on expenditure because in the same time, you've got everything out. Have a look at, and we do this in debits every year. We encourage our members to do it annually. Most people don't like doing it, right? Because it's a pain in the arse, and we don't like penny pinching. We don't want budgeting. We don't have conversations about, don't have a cappuccino and don't enjoy life. We're not saying that. Definitely not saying that. What we're saying is, you know what money's coming into your life, and you know what money's going out of your life, and whatever's going out of your life, there's an opportunity to change that. And that's the process we teach in debits. And every line of your expenditure, especially again now with technology, doesn't matter who you are, doesn't matter how wealthy you are, there are ways that you can do something that will reduce the cost of that. The competitive nature of all sorts of expenses that are in your life, from utilities to phones to the things that you do every day, there's always ways to make them a bit cheaper. And it's not that we're trying to find 10 quid here, 20 quid there. It's the money you save you redirect to either eliminating your debt, paying for insurance if there's a gap, or building wealth. And you can choose a combination of all three if that works. But either way, what you're doing is the consequence of the action is it has a triple whammy impact on your wealth. And a lot of people tell me, I'd like to be wealthy, but I haven't got enough money, or I'd like to be wealthy, I don't know where to start. Start at home. Start there. Get a detailed summary of money in and out. Identify areas where competition can definitely save you money. If you find an improvement, no matter how small, take action, and then note the money you've saved and take the money you've saved to do something to reduce your debt, insure yourself, build your wealth.
We're talking about some significant savings. We see our members obviously submitting their savings after they've been through that process every week. And it's, from several hundred to several thousand in some cases. So it's a worthwhile exercise for sure.
Yeah. And, if you do that, yes, of course, you're going to make the most money the first pass. But if you just do it once a year, I think, that's a good way to do it. So, I think, is that enough secrets for one day?
I think we've covered 5 there, and that's enough for someone to get stuck into now. And of course, we said that if you'd like to download a free copy of the Save a Fortune book, then you're more than welcome. You can head to wealthbuilders.co.uk/Save a Fortune. And it's a pretty easy read, Kevin. It won't take long for someone to go through that, but it could have a huge impact.
Yeah, and definitely, some of the lessons in there, and it was good to revisit it actually, Chris. We'll want to try and give more powerful illustrations about how this system of manipulation we have, one designed to get us deeper into debt, to pay more profit to financial institutions. It's kind of education, but in the wrong direction. And I want to change that, and I want the kids to be more aware of this, and to have parents help them understand that there's a big difference between tap convenience and paying interest rates. For some people, particularly if the whole point about me paying the mortgage off fast is here's the thing, right? Let me leave you with this one. For those of you who have a mortgage, get your mortgage offer out. Go back, find it. Get your mortgage offer. And it doesn't matter what the cost of your house is, what the cost of your mortgage is. But let's take an average. Let's say, I'll make some numbers up, Chris. Let's say the price of your house was £400,000 and you borrowed £300,000. You go, okay, I've got 75% loan to valuation. Don't feel too bad. Go and add up on the last page of the mortgage offer, which says, over the term of the mortgage, this is how much you will have paid in total. Now, I don't have a mortgage offer in front of me to compare it, but let's say for the sake of an argument, it was £800,000 total in terms of your debt. Then you paid twice as much for the house that you just bought. So you didn't pay 400 grand for it, you paid 800 grand for it. Now, it doesn't matter what the numbers are, they're always massively different. So the reason I wrote this book is I wanted people to pay off their mortgages and not see mortgage as just a convenient debt, one that everybody has. So it's all right, but it's not all right. Or at least it's not all right to think about it as okay, because the word mortgage is really a French word, which means a pledge until death. More is French for death. So, you end up somebody else owning your property if you don't pay it. So having a mortgage, okay, I get it. It's important, and most people need a mortgage to be able to get started, but that doesn't mean you stick with it for 25 or 30. I've seen young people today buying properties with mortgages for 40 years. 40 years, crumbs. And they're doing it just because they can afford the payments. So I want to change that thinking that just because you can afford the payments, make it okay. Because in the end, if you're not reducing and eliminating debt, you're going to be paying more for life, and you're going to have to work a lot harder to be wealthy. And we want everybody that we meet to be wealthier than when they came in contact with us, Chris. So here endeth the lessons on debt, at least for today.
Yeah, well, we hope you enjoyed listening to today's episode. And if you did, and you'd like to leave us a review, that would be much appreciated. And we'll be back same time, same place next week, Kevin.
Mm-hmm. And until then, my friend, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the WealthBuilders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.